Hi everyone, JJ here with The Art of Value. Welcome. Well, today we're going to look at another super investor portfolio, that of Bill Ackman, well-known value investor Bill Ackman from Pershing Square Capital Management. This is the fifth in this series of super investor portfolios. I put a link to a playlist of the rest if you hadn't caught up on those. But today it's Bill Ackman, and we can see his portfolio here on screen. It's through Ticker Terminal. This shows international investments as well as American ones. It tracks Investing Guru portfolios, and for this past quarter, which is the Q4 2023, you can see what the activity's been here from Pershing Square Capital Management. It is actually a listed company, and I'll show you that in a minute. I'll show you the performance that it's had over the past few years. We can see here the holdings and what they've been doing with them in this past quarter. Universal Music Group is fully 30.62% of the portfolio, so a huge percentage there. And here we can see that they've just added 0.29% over that past quarter, so not much to write home about there. Next is Chipotle Mexican Grill, which makes up 12.66% of the portfolio, and they've been selling that down just 13.49%, so trimming a little bit there. Next is Restaurant Brands International, which accounts for 12.24% of the portfolio. They've done nothing with that, left it alone. Next, we have Hilton Worldwide, which is 11.22% of the portfolio, and they've sold that down nearly 11% over that past quarter. And Howard Hughes Holdings, 10.45% of the portfolio. They've done nothing with it there. Alphabet, and we'll notice here that the two classes of Google or Alphabet shares there. So one accounts for 8.87 and the other one 4.08. So quite a big holding there when you add those together. They haven't added or taken away from that in this past quarter. And then we have Canadian Pacific Kansas City, which is 8.02%. You'll notice that all of the holdings are quite even except for that top heavy one of 30%. So Bill is an investor that would like to have 10 portfolio items, 10 companies in this portfolio of about 10% each. That's typical value investing. Gives you a margin of safety. If one even goes to zero, you don't lose too much, but there's also a lot of upside with a lot of conviction in pretty much each one. And we see right down here at the bottom, Lowe's companies. Lowe's is 1.86% now, and they've sold that down 82.37%. So that's the major sale or buy for this quarter. This is Pershing Square Holdings itself, which is Bill's portfolio. You can buy into Bill's portfolio this way, and we can see there over the past year it's had a pretty good return, 30.4%. This is on the London exchange, by the way. You'll notice that it's in pounds there. We can change to US dollars, and there it means that it's had a bit of a better outcome because of the exchange rate there. But we'll go back to pounds to see that. And over the last 3 years, it's had 51.4% price, which is a 15% CAGR. And over the 5 years, it's had 206.2%. And that's a 25.6% CAGR for Bill. So it's done very well. He's done very well over the years. You might know of his activist activities that have been in the media from time to time. He's had some big losses and some huge wins. And it's not all just these stocks. He does do other things as well. You might remember during the pandemic when he made over $1 billion on a bet that, the economy was going to shut down, when he said hell is coming, and he made a big deal about it on X, on Twitter. He's on there all the time talking about various things, politics. He's very vocal about different things, and it's kind of his activist nature. So that's Pershing Square Holdings. So it's done well over time, and that's a company that investors can actually buy into. Bill's investing, which is kind of like Warren Buffett in terms of being able to buy into Berkshire Hathaway. Now in the Art of Value Patreon community, I've just posted my whole stock portfolio, the current portfolio, and recent changes, and commentary about the positions that I have there and what I've been doing. I put exclusive posts like that and exclusive videos, expanded videos, all ad-free, of course. So I'll put a link in the description and see you over there. Now, if we go into some of the individual holdings here, we can see that big one at the top, which is Universal Music Group. We can see over the past year, it's returned 20.8%, which is pretty good. And we go to all here, we can see it's returned 15.3%, but it's early days still. That goes back to only September 2021. And now to GuruFocus. I'll put both of the links to those referral links if you want to check them out. I'll put that in the description. We can see here the metrics for the company, so we can get sort of an inkling, an idea of how Bill invests, what kind of companies he invests in. Are they quality companies? And it turns out that mostly, yes, they are. He says that they look for quality companies that are compounding over time, and, less than 10 bets at a time, big bets that they have, and the probability of compounding over time. So we can see here, this is quite a big company, market cap of 53 billion, enterprise value of 55. The metrics here, if you saw my other video on Terry Smith, it's kind of similar metrics that he looks for here, which a lot of kind of value investors do. We go straight down to here to my favorite ROCE, return on capital employed, which is 27 right now for the past year or so. And that means that it's a way above average. The average is about 15 for the S&P 500, and this is 27, so way above average for return on capital employed. And the ROIC, the ROIC, is 11, return on equity pretty high, gross margin 44, operating margin 13. So these are pretty good metrics, and we can get an idea of why, superficially, why Bill might be interested in this company. The ratios here currently look a bit on the expensive side, just superficially, but Bill's had this for a while. Now we go to Chipotle Mexican Grill next down the list. For the last year, it's returned a whopping 74.3%. And over the last 3 years, it's returned 84.8%. That's a 23% KGAR. Over the past 5 years, 296.7%. That's a 32.3% KGAR. So it's been an incredible performer, as a lot of people do know, over the past few years. And even 10 years, it's done well. Going back 10 years, 343%. And that's 16.2% if you'd been in it for that long. And if we turn here to the metrics again, we can see that it's a big company, 72.5 billion. And we can see the metrics down here, the ROCE is 25, so well above the average again. And we can see these metrics are all in the green here. ROIC is 19, gross margins 26.2, operating margin 16.54, net margin 12.45. And we can see that GuruFocus here is saying that it's modestly overvalued. Bill's been in this one for a while again, and it's been doing well, as we saw. The next one down the list there is Restaurant Brands International, which over the past year we see has returned 18%, and over the past 3 years, 21.3%. That's a 6.7 KGAR, and 5 years, it's returned 21.5%. So we see this is a $23.75 billion market cap. And the metrics again in the green there, we see the ROCE is 9.77, which is not so much there for the last year. The ROIC is 11.73, and gross margins 39, operating margin 30, net margin 16. And we can see here GuruFocus says at the moment it's about fairly valued. And Bill Ackman has been in this one a while too. Next on the list is Hilton Worldwide Holdings. We can see over the past year, it's up 37.7%. So again, doing well for Bill there. He's had this one a while. 3 years, it's 63.3%. That's an 18% KGAR, so a good performer there. And over the 5 years, 133% and 18.8%. So really a good performer. And over the 10-year period, 191%, 11.4%. So I think Bill's had this for maybe 3 years or more. So he's been doing very well out of it. This is a $51 billion company. So he does have mostly large caps. It's a big fund. So again, like Warren Buffett, or not so much to that extent, but they have to invest in fairly big companies in terms of being able to move the needle. You know, they can't invest in tiny companies. It would just be too much. He does do that personally, I think. I think he's invested in Tiny Limited, which is a serial acquire company, a small one from Canada. I know that because I've heard the CEO talk about how he met Bill and Bill invested in his companies. But that's aside from this big fund. Now, if you're getting value out of this episode so far and you think I've earned it, please don't forget to hit that like button to help the algorithms, the almighty algorithms, to spread it to more people, because that's what we want. Thanks. And we can see here the gross margin is 28.63, operating margin 22, net margin 11. We go down here to the ROCEs 18.23, which is above average, and the ROIC 10.28. So good metrics again, which is what you'd expect from a company that Bill Ackman would be involved in. GuruFocus says here it's fairly valued. Take that with a grain of salt. I haven't done my own work on this, and you should do your own work. None of this is investing advice. You've got to do your own work or not take the word of a site like this. This is just an indication to see if we want to dig any deeper. But we can see the PE ratio is 47, which is pretty high there. Forward PE ratio 29. You can see the 3-year revenue growth rate 35.6 there on the left, which is pretty good. So let's move on to the Howard Hughes Corporation. This isn't really talked about quite a lot. Past year, it's actually minus 7.7%. Over past 3 years, it's 17.6%. Not so great. And over 5 years, minus 29.1. So not performing very well there. But it remains to be seen whether it will do well for Bill over the long term. He would be prepared to wait, I think. Value investors are prepared to wait some time for things to turn around, if it is a turnaround, or if there's a catalyst on the horizon, or for things to move up 3 years or even more than that. If we go to the metrics here, we can see it's a $3.87 billion market cap and 8.6 enterprise value. So it's carrying quite a lot of debt there. We can see the debt to equity is 1.77, which is pretty high. Go down to the ROCE, negative, and all these numbers are negative. So it's not looking so great, but there'll be a reason that Bill's invested in this company. I don't know what they are. We can't tell by just looking at these metrics, but there'll be a good reason. It is over 10% of the portfolio, so it's a significant position. So it's going to be interesting to see what happens with this if it starts moving up, starts doing well for Bill. Now we move to Alphabet, Google. The two positions there, we just need to look at one because they're pretty much the same. We can see over the past year, it's up 57.6%. A lot of people know about Google, of course, about Alphabet, one of the Magnificent Seven. It's been doing well, and Bill has been bullish on it. So over the past 3 years, it's 39.9%. That's an 11.8% CAGR. And over 5 years, 146% and a 20% CAGR. So, I think we all know what Google's about and how well it's been doing over time. And there's no surprise there when we look at the metrics that they're pretty good. So market cap is 1.8 trillion at this point. That's a huge company, of course, a mega cap. And if we go to the metrics down here, there's no surprise that we can see that the ROC is 28. There's no surprise that that's way above average. And like returns on capital here, return on equity 27, return on invested capital 29. Gross margin 56, operating margin 27. So these are exceptional numbers. There's question marks over how AI, the new language models, will affect Google. There's competition going on at the moment. I'm using Google Gemini at the moment. Google's just come out with this. I'm using the advanced version to see how good it is. So far, it's pretty good. People are speculating whether their search engine, whether their search monopoly, and let's call it what it is, its monopoly is going to get disrupted by these new AI models that are coming out. So we'll have to see, but Bill seems bullish on Google for the moment. What do you think of that? Do you think that Google's going to be disrupted? Do you think that their search model will be disrupted by these AI models? Let me know in the comments about whether Google can keep up, compete, and pull ahead. And even if they can manage to compete, is their search engine, advertising going to get eaten away? There's a question mark about what's going to happen in the next few years. I mean, they've had such a monopoly, such dominance in this for really 2 decades now. So is that going to end? What do you think? Let me know in the comments. Okay, next is Canadian Pacific Railway Limited. So over the last year, it's had a 10%. Over the last 3 years, it's 26.4%. Warren Buffett is also pretty keen on railways here, so he's got that in common with Warren Buffett. If we go back 5 years, we can see that it's 109%, 16.2 CAGR, so really a solid performer. Railways still perform solidly. Railways are still being used for freight, definitely. Freight is always moved around by a railway. It's one of the most efficient ways of moving goods around. We can see here it's an $80 billion company, so big again. And if we go to the metrics, we can see that the ROCE is negative at the moment. We need to look into that to see what's going on there with some of these returns. Obviously, there's a reason that Bill is keen on this company. The gross margin's 50.73. Would you think that for a railway company? Operating margin is 36.2. 8 and net margins 31. Would you think that the metrics would be like that for a railway company? And GuruFocus is saying this is about fairly valued at the moment. I think Bill's had this for quite a while too. It doesn't change around quickly. There was that time when he went into Netflix, made a big deal about it, and then pulled out of it a quarter later, changed his mind about it. But he doesn't do that very often. Maybe if it's an activist thing he does, he goes in to be an activist and changes it and then gets out of it when the company does change and things move up. But generally, if it's a long-term hold, a compounder, he will just sit on it for quite a long time. We can see how they usually do pretty well. He's done well, and Pershing Square has done pretty well over the last few years. Now we have lows. Remember, this is one of the big sell downs they've had over time. So over the past year, it's 14.6%. 3 years, it's 44%, which is a 13.1% CAGR, which is not too bad. Over the past 3 months, it's actually up. And over the past 5 years, it's 117% and 17.1% CAGR. So they haven't sold this because it's gone down already. That's not the case, but obviously he's lost conviction. So for Lowe's, this is a $133.7 billion company again, so pretty big. And the enterprise value is 171. So a reasonable amount of debt that they have there, I think. But the metrics still look good. We've got the ROC of 44.9, which is very impressive. And the returns on capital there looking pretty impressive. Gross margin of 33, operating margin of 12, net margin of 8.5. But there'll be a reason that Bill sold out of this. Maybe he's planning to get into something else, or he has already. We'll just have to see, wait for next quarter and see if that's the case. Now, if you're watching this video on YouTube, I'm going to put a link here to that playlist of previous Super Investor portfolio updates that I've done. This is the 5th in this series, as I said, so go and catch up on those if you haven't already. I'll put a link in the description as well for those elsewhere to go and check those out. And thanks for everybody for watching or listening, and I'll see you in the next one.